Unlocking daily buyers has been a game changer in my trading journey, and today I want to help you experience the same transformation. In this video, I've been able to break down daily buyers into two simple yet powerful concepts, which are liquidity and institutional order flow, the keys to identifying higher probability trades. But here's the truth. Understanding daily buyers isn't about predicting every bullish or bearish move. There will be days when price action feels unfair, and those are the moments to sit back and let the market reveal its story. By the end of this video, you will have the tools to approach the market with clarity and confidence. So stick with me. Let's dive in. So we're going to start with the first concept, which is liquidity. Market liquidity refers to the degree to which assets in a market can be quickly bought or sold. Now we can see that liquidity is essential for efficient exchange in the marketplace. To facilitate this, algorithms are designed to move price in search of the liquidity necessary for seamless asset exchanges. This implies that liquidity is a primary driver of price movement in the market. Price movement on your chart is only representation of price-seeking market liquidity. Everything I'm trying to say is that liquidity is what drives price. Where there's liquidity, that's where price goes. And the algorithm has been designed to move price to where there's liquidity. Where can we find this liquidity? We can find this liquidity at highs and lows, swing highs and swing lows. Let's say this is a chart. So we can see the peaks and troughs. Liquidity will be located here and here. Very, very simple. So price movement, as we see on our chart, is only a representation of price seeking what? Liquidity. Very, very simple. All right, let's move on. Liquidity delivery. Now, something we need to understand in order to be able to grasp the whole concept of daily buyers is understanding liquidity delivery. How is liquidity delivered? Now, liquidity is classified into external range liquidity and internal range liquidity. The external range liquidity consists of the buy side liquidity, which is found above the range or high, and the sell side liquidity, which is found below the range. So it's just very simple. We have something like this. Price created a range. Like this is a price range. All this move here is a price range. So here is a price range. From here to here is a price range. From here to here is a price range. From here to here is a price range. So let me take it out. So once price, this is like a price swing. So this is a range. Here to here is a range. So the liquidity above and below this range, we call it external range liquidity. And then for the internal range liquidity, it consists of what? Fair value gaps and then short-term highs or lows. So for this range here, probably in a lower time frame, this whole range here, let's say this is a 1 hour time frame, and then this is what 5-minute time frame or 15-minute time frame. You would notice that as price moves, it creates lows and highs, lows and highs. So as price is retreating to this range, we have what? Short-term lows, and probably there might be fair value gaps here. So price usually moves from external range liquidity to internal range liquidity. Now the chart, the whole slide is messed up, so let me clean it out. It's very, very simple, guys. Market moves from what? External to internal. If we understand this, we need to understand daily buyers. So now when we're in a trendy market, if there's an internal liquidity and probably let's say there's an old high here, once price has taken this external liquidity, we're expecting price to retrace into the internal liquidity. And we don't just expect price to retrace into this range. The internal liquidity tells us how far price is going to retrace. So this range here, we're going to be looking out for what? Fair value gaps in this range. I'm also going to be looking out for short-term lows because this is bullish range. So for a bearish range, we're looking for short-term highs for price to go to take the liquidity for it to continue going downwards. It's very simple. All right, so let's move on. So here's a diagram that depicts what I just explained. So you can see this is a range. Inside this range, we'll call internal range liquidity, and what is above or below the range is called external range liquidity. So here's an example in the charts. We can see how price moved from internal range liquidity, which is a fair value gap, like I explained before, or swing high. So let me go back so I will show it to you again. So I explained that internal range liquidity include the fair value gaps and short-term highs or lows. So we can see here in the chart, there's a short-term high here. Let me outline it. So you can see this short-term high, and then you can see this fair value gap. So price moved to internal range liquidity and then moved to external range liquidity. After taking external liquidity, price moved toward internal liquidity, fair value gap, and then fell to take what external liquidity, and it continued like that. And this usually happens in a trendy market. And if a market is consolidating, you usually don't see this happen. That's why you want to be in a trendy market. You don't want to be in a choppy or consolidating market. With all said, liquidity delivery is well seen in a trendy market. All right, the next, which is institutional order flow. Now, I could remember when I started learning this, I didn't understand it. I spent a lot of time trying to understand institutional order flow. And when I got it, it opened everything to understanding buyers. It was like the key to my understanding of market movement. Institutional order flow is very important when it comes to understanding buyers. So institutional order flow is not complete without liquidity. That's why I had to explain what liquidity is, how to identify it, and its delivery. Now, from the previous slide, we've understood that market move from external liquidity to internal liquidity, and from internal liquidity to external range liquidity. So now we're talking about institutional order flow. What is institutional order flow? Institutional order flow is the buying and selling activity of large institutions like banks, hedge funds, and other financial entities. So we can see from the definition that institutional order flow is as a result of big institutions where there is bulk of money, and bulk of money is what moves the market. So now institutional order flow can either be bullish or bearish. Now, what you want to do as a trader is to be able to find out the telltale signs or the handwriting of these institutions to be able to go with the flow. So if large institutions like banks, hedge funds, and other financial entities are going to be buying, how can you tell? That's what constitutes the understanding of institutional order flow using your chart. There are things you look out for that let you know that, okay, since these have happened, the market is going to go bullish. So calling it institutional order flow is only explaining that this is what large institutions are likely to do. So institutional order flow could either be bullish or bearish. So it's just like calling the market bullish or bearish. Now, how do you determine the institutional order flow? How can you tell that the market is going to be bullish? Meaning that large institutions like the bank, hedge funds, and other financial entities are going to be buying. How can you tell they're going to be selling? There are things you look out for. Now, I've been able to simplify it to two things. Number one, it has to have an origin and then a terminus. Now, what does an origin constitute? An origin is the institutional level where we have the order blocks, the breakout blocks, and then the fair value gaps. Now, you want to be seeing this in a higher time frame. Your institutional level should be identified in a higher time frame because huge institutions don't work with small time frame. They work with huge time frame like the daily, weekly, and monthly time frame. So you don't want to be looking for 1 minute order block, 5 minutes fair value gaps, or 5 minutes breaker blocks. You want to be using daily order blocks, weekly order blocks, monthly order blocks as an origin, which will serve as your institutional level. And then the last, which is the terminus, you want to be identifying the liquidity. Where is market likely to go? So let's say there's an order block here. Price is likely to find support to rally where? To where there's liquidity. And liquidity is very easy to find above the highs. And the reverse is the same for a bearish order block. Let's say we have a bearish weekly order block here. If price rallies to this point, we expect price to find resistance to run lower to take out whatever lows that may be here. So we have the origin and the terminus. So if you can identify these two things, you are good to go and determine your institutional order flow. All right. So here's an example. We can see this is the gold market. Here is a weekly time frame. This is our institutional level, which serves as our origin. This is a bullish order block. Now you can see how price found support. Now, without this being printed, when we see price getting to this low, taking out liquidity, filling this fair value gap, finding support in this what? Bullish order block, we would expect that price will rally higher to take what? This liquidity above this high, and then finally above this high. So we identify our terminus, which is here, 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 and our origin, which is at this point. So it's very simple. You want to go to a higher time frame to look for institutional levels, anticipating that if price gets to that point, it will rally towards the opposing liquidity, which is what we can find here, the buy side liquidity. And when we find that, we then classify this whole run as a bullish institutional order flow. And once we classify this as a bullish institutional order flow, all we are saying is that price would find support in every other block, fair value gap, or breaker block that is formed as price rallies up in order to protect price from falling downwards and achieving the goal of attaining the buy side liquidity. Here's another example. This is the euro dollar. This is a weekly time frame, and we can see that these are a very good origin. Why do I trust this as a very good institutional level? Price has swept this low, broken structure to the upside, retraced, and then this low is being protected, so it has formed an intermediate term low. So we can see this low that is higher than this low, and this low here higher than this low. So we form an intermediate term low, and price has broken structure again. So if price should run lower, I expect price to find support here to rally higher. So once price gets to this point, without seeing this, because we are all looking at this in hindsight, so we are picturing the chart without these three candles being printed. So once price gets to this point, this is the fair value gap, a weekly fair value gap. We are anticipating that the institutional order flow is bullish. So we want to be buying. And we don't just establish the basis that price is now bullish. We want to look for an opposing liquidity because we are expecting market to rally higher. We want to look for buy side liquidity. Now, we can use this as an example. Here's an what? Bearish order block. Now, as soon as price hits it, now you can see this high being formed. Before these candles are being printed, we want to classify the institutional order flow to be bearish because we're anticipating that price will rally lower. For what? Liquidity below the market. So we can see this low here. And if you look at this point, price did not get to this low, but here is liquidity. So these are our opposing liquidity. So here will be the terminus and here will be the origin. So it's just about identifying where is market likely to go. That's what institutional order flow tells you. Where is market likely to go? Where is it going to originate that move? And where do you think market is likely to go? Now, before these three candles would be printed, you could as well assume that price was running for this high. Now, remember, these three candles are not being printed when we are seeing this candle finding support in this fair value gap. So now, once price finds support in this fair value gap, we might be expecting this high to be taken. Now, if this high is taken, we want to watch to see if price wants to continue going higher. And there are things we look out for that will tell us that price wants to keep going higher. And you can see that price at this point, we'd expect that price might still run higher to take this high. So at this point, our institutional order flow is still bullish until we see something like this here happening here. What do I mean? Want to see an institutional level price getting to that level and reacting. So let's say another block is formed here and then price maybe rallies lower, probably forms a low, rallies higher, then breaks structure or something happening at this point here. Once price returns to that level, of course, another block has been formed here. So I want to outline this low. We're expecting that price will rally lower. Our institutional order flow will change from bullish to bearish. We will now have a bearish institutional order flow. So we want to be going down to smaller time frame like the daily time frame, 4-hour, 1-hour time frame, which serves as intermediate time frame if you're a day trader, and expect every institutional level to hold price from going higher. What are those institutional levels? The bearish breaker blocks, bearish order blocks, bearish fair value gaps, bearish mitigation blocks. So we want to find them and use them for a trade. So the first thing starts from what? Identifying the institutional order flow. And institutional order flow is not complete without knowing where the liquidity is. So it's all about knowing where is market likely to go. All right, so let's move on. So the previous slide we saw was a weekly time frame. That's the euro dollar. So here's a daily time frame. I explained that when institutional order flow is bullish, we want to expect every institutional level to support price to go higher. So now we're going down to a daily time frame. We can see that this is an institutional level, which is a fair value gap. You can see how price found support and then rallied. Price retraced again into another institutional level, found support, and then rallied. You can see something happening here again. This is a fair value gap, very small, price did what? Rallied. Here's another fair value gap. So now this example here only used fair value gap to rally. Sometimes it might use order blocks, sometimes it might use breaker blocks. Here would have been a breaker block. You can see how price took out this low. Sorry, let me draw it more better. So we see price took out this low and then broke straight to the upside, but price failed to return lower. So we're using this fair value gap. So you can see our price for support before rallying. Now, why is all this happening? Because institutional order flow is bullish. So you want to get institutional order flow and go with the flow. This is very important when it comes to determining the bias. So now there's some tools I've been able to put together. I call them the Bellwether Tools. These tools are very important to understand when market is likely to turn. Now let's take, for example, if market is trending like this. Now, let's assume there's a fair value gap here. There's an order block here. Now, how do you know market is likely to turn from this point? What if market still wants to continue going lower? Probably to find support in this order block, this bullish order block. To know this, I've been able to put together these tools. So the first is a three candle pattern, and it has to be in the higher time frame. Second, the smart money tool. The third is shift in market structure, which I'm sure we are all aware of, and then the power of three. So the power of three deals with more of the entries. So in case you don't understand what I mean, I'm going to explain it further in the next slide. So for the three candle pattern, it's very easy to spot. You want to see the middle candle being lower than the candles by the left and right. And then if it is for bearish swing, you want to see the candle at the middle being higher than the candle by the left and right. So it's just very easy to see. You can see the pattern here. So here's a fair value gap, which is an institutional level. So how do you know the market is likely to turn from this point? One very powerful key we can use is what? The three candle pattern. And what makes it very powerful is when liquidity has not been taken. Remember I said in the previous slide, earlier on, market moves from what? Internal to external rate liquidity, and then from external rate liquidity back to internal rate liquidity. So what increases the likelihood of price moving higher when we see a swing low formed by the three candle pattern in the higher time frame is when liquidity hasn't been taken. So here is another example. We can see that liquidity has been taken. Now, it doesn't mean that the next candle that will be printed can't be bullish, because all I'm trying to say here is that you will see this three candle pattern here. The candle that will be printed next will be bullish, because this forms the foundations of understanding bias. So how do you know that the next day will be bullish? How do you know the next day will be bearish? When we see this three candle pattern happening, we're in an institutional level, in a higher time frame, we should anticipate that the next candle that will be printed will go in that direction. This here has a higher probability of printing a bullish candle here than this. Now, it doesn't mean that a bullish candle can't be printed here, but the probability here is lower because external liquidity has been taken. So price might probably retrace down to find support in this order block before rallying higher. So this day, if you are buying as price is retracing, you might be losing money. And that day, price might still retrace, find support, and then rally. It can happen like that. And I always say it in Forex, it's all about probabilities. You want to work with what gives you a higher probability. This here is what gives a higher probability. You want to see the external liquidity left untouched as price forms a three candle pattern in a higher time frame, finding support where in an institutional level. All right, so let's move on. So the second is a smart money tool. Smart money tool is a crack a correlation between two correlated assets. They could either be directly correlated or indirectly correlated. So we have the USD, Japanese yen, and dollar. They are directly correlated pairs. So when there's a cracking correlation, that is, if the USD yen makes a higher high and dollar fails to make a higher high, we have what we call SMT divergence. So when we see divergence, it's telling us that smart money is in play. Our market is likely to reverse. So let me give an example. Let's say price is rallying like this. This is the UJ, and then we see dollar going like this, still rallying, and then failed to make this higher high that was made here, is a telltale sign that price is likely to reverse. So let's say this is a bearish market and price was only retracing into this range. So it gives an opportunity for you to know when market is likely to reverse. Smart money tool is a very good bellwether tool. So let's move on. Then we have the shift to market structure. This structure is very easy to identify. As simple as it is very powerful in telling you where price is likely to go. So when we see market taking a high and then breaking structure, so we can see the reverse. Let me just draw the reverse. Market taking a low and then break structure to the upside. We expect that if it retraces back, price will rally. So now let's take, for instance, you're in a higher time frame, let's say a daily time frame, price is rallying. Now, price gets to a fair value gap in this daily time frame. How do you know price is likely to turn? You can go down to an intermediate time frame for a day trader. An intermediate time frame will be your 1 hour or 4 hour time frame. And then you see something like this. Here is a tell sign that price is likely to continue this trend. When you see this, you would be most likely to be buying the next day that will be printed. So these are bellwether tools to tell you when price is likely to stop being trendy, probably wants to retrace, because if we see something like this again, this same pattern can be seen at this point here. So we can go down to a 1 hour or 4 hour time frame and we see the shift in market structure would likely not continue buying. We want to wait for price to retrace into this range, or we could fade the trade. Instead of buying, we want to start selling. And then once price gets to an institutional level here, we could also do the same to look for a shift market structure. Now, we may not see a market structure most times in price. One other tool we can use as a trade candle pattern in the higher time frame. And if we don't see that, we might look for a smart money divergence. These are things that we can look for to tell us that market has shifted, market has stopped trending, and market is about to reverse. I hope we get that clear. Now, one thing I failed to mention about institutional order flow, let's go there quickly. Now, once price gets to an institutional level, like we see here, this is a weekly fair value gap, and we call this bullish. We want to go in buying every single day. All we want to be doing is buying till price gets to what? Terminus. Now, this could also be your terminus, this high here. And if price continues going higher, you would keep buying because we still have this high on tag. And at this point here, you could also continue buying. Sorry, this is awful. This high here is still untapped. So until we see something here, like I explained before, telling us that the objective have been met and institutional order flow has shifted from bullish to bearish, then we can stop buying. Now, the bellwether tools which I've explained to you are just tools that you can use to refine your trades, because you can see from this point, let's go to the next slide. That's the daily time frame. This is a weekly, and then here is daily. Not every day was bullish. So you have this candles, this is a bearish, this is a bearish, bullish, bearish, 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 bullish, and this is like a range. You may not even make money here that much. So not every day was bullish, although market was bullish. But you want to be buying most of the time, because if you count the amount of up candles, they are more than the down candles. So let's do that quickly. So let's say you are buying from here as price. Immediately as price hits this fair value gap, we want to start buying. So we have this green candle here. This is 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20, 21, 22, 23, 24, 25, 26, 27, 28, 29. Okay, already we can see that the up candles are more. No need to count so that we don't waste any more time. So now, once price gets to this stop, because we've already explained that market moves from what? Internal range liquidity to external range liquidity. So if price takes external range liquidity, we're anticipating that price should return into this range for what? Internal range liquidity. Now, is it going to reverse here? We don't know. Let me take this out. Is it because we can see that this, okay, I think I should get back. Let me clean this and then clean this. All right, and then let me see if I can expand. Okay, let me expand. Beautiful. So now we can see that the line has gone. Okay, let me draw another line. Good. This is what external range liquidity, and it was taken by this candle. So now, since external liquidity has been taken by this candle, how do we know that the market wants to start going lower? We are now going to apply those Bellwether tools I explained. Number one is a three candle pattern, so we can see 1, 2, 3 in the higher time frame that has been formed, telling us our market. Let me just take this line out because it's not even doing what I wanted to do. Then the market wants to go lower into the internal range liquidity. Now we can go down to the 4-hour, which is the intermediate time frame, or the 1-hour time frame, and we might see a market shift. And then another thing we can also look for is smart money divergence. We're going to be comparing this with the DXY, which is an inversely correlated pair to the euro dollar. We might see divergence. We might not, and we might. So they're just bellwether tools we can use. And we can see here again, this is a three candle pattern. This is 1, 2, 3. As soon as we see this, we are not using this because here is not an institutional level, but here is an institutional level. So when it's happening in a higher time frame, at an institutional level, we expect that price should rally. And we're seeing the same thing here, the three candle pattern, 1, 2, 3. So that this candle, the middle, is lower than both candles at each side. And then the price continue to rally. Now we can see something here. Now, why are we seeing this awkwardness? Price has already taken the liquidity. All right, so let's move on quickly. Now, the last bellwether tool is the power of three. Now, this is majorly used for entries and not necessarily used as the other bellwether tools. It's just likely they're just used for entries, and I'm going to be explaining them in the chat. So let's say this is a bullish day. We're going to be buying below or at the open of price. So this is the market open. This is where you want to be doing your buying. Why? Because usually you see an accumulation at the open, probably the Asian range, and then the protraction, which is against intended move. Let's say that's a bullish day, like you can see here. You see market protracting against the intended move. This usually happens in a London session and then rallying, and we call that what? Distribution. So this protraction is called manipulation, and then the rally of price is called distribution. So we're going to be seeing this as I explained further. So now let's wrap it up together. Remember, I explained liquidity and institutional order flow. Liquidity helps us understand where market is likely to go. But you don't just pull out liquidity because you can see we have highs and lows. So does it mean that price will go to this low and as well go to the high? No, that's where institutional order flow comes in. Institutional order flow tells us which liquidity is price likely to reach for. Is it the buy side liquidity, sell side liquidity, or the fair value gap above price, fair value gap below price? Another very important factor which I spoke about while explaining liquidity is external liquidity. Price moves from external liquidity to internal liquidity. But when price is at an internal liquidity, expect price to go to the external liquidity. Now, looking at price action here, we can see that this is a what? This is a weekly time frame, guys. This is a bullish order block, which are outlined here. Now, price has taken what? Sell side liquidity and has broken structure to the upside, telling you that price wants to go higher. As soon as price gets to this institutional level, this is a bullish order block, we anticipate that price will rally higher. Now, where is it likely to go? This high and as well this high. This already tells us that institutional order flow is likely to be bullish. Now you can see price rallied higher. So when we determine the institutional order flow, we want to be going to our daily time frame because we're discussing daily bias, which is seen in daily time frame. This method of identifying bias can be used in any time frame, weekly, monthly, even hourly time frame. Just about you identifying the liquidity and institutional order flow. And institutional order flow has to do with the origin and the opposing liquidity, which we've outlined here. Now, we don't just use the origin, which is the institutional level, and opposing liquidity. No, we use everything to tell the story. Like I stated before, price has around what? Liquidity, finding support in this bullish order block, and has broken this high. So we expect that if price should come into this internal liquidity to find support in this bullish order block, price should what? Rally higher. This is what? Internal liquidity, this fair value gap and this order block, external liquidity. And this is two candles, guys. This is weekly candle. These two weekly candles can be used to make money in the daily time frame. You want to go into the daily time frame and be buying. All right, so let's go to the charts. So here's the daily time frame of the chart we saw in the previous slide. This is the British pounds. If we go to the weekly, we could see that price found support here before rallying. So if we go to the daily time frame, at this point here, as soon as price hit this order block, we know that price will find support to rally higher, meaning that institutional order flow is bullish. So one thing we can use, like I said, the Bellwether tool is the 3 candle pattern, and we are seeing that happening here. So when we see this candle, this candle, this candle being formed, we want to see the next candle bullish. And that was what happened. This candle was what? A bullish candle running for this high. The next day, you'll be going in to buy, but what happened? We got a bearish candle. Now, it's okay, you take a loss. One thing we should understand is that you can't predict every move. Bias has to do with probabilities. But look at here again, we got another opportunity. So when you lose this day, because price took out this low, we want to wait for the 3 candle pattern. And we have it here. So we have this candle being the lowest candle. So we expect the next candle to be what? Bullish. And that's what we got here. Now, this is a bearish candle actually, but it expanded higher. So you can take this trade. If you look at this wick here, it took out this high. So you buying here or at this point for price to rally higher is a profitable trade. So if you're a day trader, you will be going down to a smaller time frame to look for entries for a buy. And then we can see this candle was bullish, 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 bullish. So if you may be taking profitable trades here, and here may be a loss, which is okay, also fine. And you can see the remaining candles were what? Bullish. And let's say you don't want to use a 3 candle pattern, you want to look for what? Market shift. You go down to a lower time frame, or you may also want to look for divergence. So if you see from the 4-hour time frame, here's our order block. Looking at this, we can't see any significant market shift because we're looking for something like this. Probably price taking this low, then breaking this high to rally higher, but we can't see anything like that. So it doesn't mean we would see all the Bellwether tools. Another likely one we can use is SMT divergence. So we want to compare with correlated pairs. So this is the British pound. So we want to compare with the euro dollar. So let's look at it. So good. We can see divergence happening here. You can see that this low was taken here, but here there is no low. This low was not taken. Euro was actually very strong. You can see this low here was not taken. So there's divergence. So you could use this to tell you that market wants to start going higher from this what? Order block. All right, I just moved it. Okay, so let's go back to the daily time frame. All right, so market was bullish. Now remember, market moves from what? External liquidity to internal liquidity. So once external liquidity has been taken, you want to take your foot off the gas. Although you can see after liquidity was taken, market was still bullish here, here, here before falling. And then you can see that 3 candle pattern happening here. You see this candle in the middle here, here. Although it happened here, you don't want to be selling straight away because market is bullish. So you could wait for further confirmations. So this trade here, you could fade it by selling because you understand the market moves from external liquidity to internal liquidity. But as a new trader, you want to be buying when institutional order flow is bullish and selling only when institutional order flow is bearish. Another thing you can do is you can be going higher risks when market is moving in your bias or going in the institutional order flow, and then risking less when market is retracing or going against the institutional order flow. So you can see as price retraced where we have this order block here. And then you can see that 3 candle pattern being formed here. You see 1, 2, 3. So you want to resume your bullish bias. Although here you might have taken a loss, and then you can see our price continue to rally. Now, how can you use this? Applying the power of 3. So if you go down to the 1-hour time frame, let's look at it. So you can remember this is our order block. This line is our order block. We've already deduced that price wants to go higher. And then we confirmed the market was going to turn from this point by the SMT divergence, which we saw with the euro dollar. We saw the three candle pattern being formed at this point here. So now, this day is a Tuesday. We'd expect that price should go below the market open before we buy, and we can see it happening here. This is happening where? At the London Q zone. So you can see this protraction, like I explained. This is the exchange session. This is accumulation, manipulation, distribution. Same thing happening here. When market is accumulating, you can see accumulation here. Manipulation, what? Distribution. It's happening where the London Q zone. So you want to wait for price to go lower. This is a 1 hour time frame. So if you go down to a lower time frame, like 5 minutes, 1 minute, 3 minutes, you can look for entries. So you can see our price is taking out this low to find support where in this bullish order block. The same thing here again. It's not much. Accumulation, manipulation, distribution. So we can see this price protracting is there. It's not much. So I don't expect price to be perfect. You just want to use probabilities. And it doesn't happen all the time. So we can see another example here. Although New York gave a lower low, taking out this low. So your stop loss was here, you would have been stopped out. But already, if you should enter here, you should be looking out to take your profit above this high. Here is reasonable enough. How many pips? Let's say we're entering somewhere here. So this point is 14 pips. Well, it depends on how many pips you are risking. But let me take this out. I don't want to spend too much time explaining these concepts. So you can see here again, price retraced, or I would say protracted against intended move happening where in the London Q zone for rally. So we see the accumulation, manipulation, expansion, rather distribution. So here would have been a losing trade because you can see price actually went above the market open into this bullish order block, sorry, bearish order block before running lower. So we have little opportunity here happening where in the London Q zone before rallying. The same thing here again. So you want to be going to a lower time frame below the market open because you've already termed this what? Bullish. You are saying that institutional order flow is bullish. You want to go every day looking for buys below the market open. If it is a bearish institutional order flow, you want to go in every day looking for sales above the market open. It's very simple, guys. Now, external liquidity has been taken here. So you want to take your foot off the gas. So as soon as this happens, this is what a Thursday. Tomorrow you want to go sitting on your hands, or you may actually go in with half risks because you're expecting market to retrace into the range. So you can see our market was actually crazy at this point because external liquidity has been taken. Market is trying to turn. So this is a three candle pattern which was formed in the higher time frame. At this point, you can also fade it. If you know what you are doing, you can start selling. So you can see this is the market open. Let me expand so that we see it better. So you can see this small. You can see here, give an opportunity for you to sell. Here again, you'll be selling here. Here you got no opportunity. At this point, probably you may take a loss because you may use this as an opportunity to sell. The price takes you out. Or you sell and then take your profit below this low, which is reasonable enough. Here again, another opportunity, price taking out this low, filling this void. Bearish order block, price rallied lower. The same thing here. But might have lost this trade. There's no opportunity here. Very good opportunity. You sell, go higher, you sell. But when you simple like this, you want to take your hands off the market because you are looking for something very simple and then profiting from it. So you can see how price kept going lower till this point. Now, if you go down to a higher time frame, I explained that the three candle pattern can be seen here. So you can see this three candle pattern here. Because price is retracing into where a weekly fair value gap. So this is the weekly fair value gap. Let me outline it. Ooh. So as soon as price retraces, this is the weekly time frame. So as soon as price retraces here, we're looking for that three candle pattern. So we can see it being formed here. And then we'll be expecting the next day to be bullish, so might go bullish and we'll lose the trade, which is fine. At times you take losses. Then you wait. After this candle is being printed, you are looking for that three candle pattern to be formed. So you can see the three candle pattern was formed here. And what happened the next day was what? Bullish. The next day, bullish. The next day, undecisive. Bullish, bearish, bullish. So you start buying. So you are expecting bull run till this high is taken and probably this high taken. And so you can see it. Another thing you can also look out for. Let's say you want to combine another Bellwether tool. Because if you see this happening, so let me just outline this here. So you might not be taking a trade probably after seeing this, because you want to go down to a lower time frame to confirm to see if there's any shift, market shift, or if there's any smart money to divergence. So if you go down to the 1 hour time frame, so let's see it quickly. So here is the low that we saw. If you look at it, there's no shift. There's really no shift here. I don't know if there's any divergence, which will further confirm the reversal. So you can see there's really no divergence here. Price made a lower low, and actually here it got lower. But at this point here, you can see a shift. I think I was seeing this. I noticed a shift here. This is a very beautiful shift. Let's go to a 4-hour time frame. We'll see it more clearly. So you can see price took out this low, broke to the upside and then retrace. So we are seeing a shift. So once this shift happens, it tells us that the next day will be bullish. So let's go to the 1 hour so that we'll see the daily time frame, or we'll see the next day properly. So here is our retracement. So maybe we might miss this day. We'll be trading this day. The next day we want to wait for price to go lower, so we can see happening where this is not even happening in any of the Q zones. So we want to wait for what? London, sorry, this is the New York. It's happening at the London close. So probably we don't get any move, because when you say price is likely to go higher, you want to sit on your hands until price goes below the market open. We see how price is going higher. You don't want to do anything. You want to wait till price gets lower. And when price gets lower, you want to be executing at either of the Q zones. Usually, you want to be using the London Q zone for European pairs like the Euro dollar and British pounds. For the USD yen and other pairs paired with the dollar, you want to be using the New York Q zones. And then for Asian pairs like odd dollar, you can use the Asian Q zone. All right, so here again, we don't have an opportunity. You can see this happening outside the Q zone. That's okay. You don't need to look for trades every single day. Sometimes you don't get trades. Trading 9 to 10 times in a month is very, very good. It's very, very okay. Less is more. Here again, you can see price retracing lower and then rallying higher. Here's a trade. This is happening in London. Here is a protraction. So if you should bought here, taking your profit above this high is very okay. So let me draw a line clearly so that we see it. See price took out this high. Here again, we can see this happening where in the New York Q zone, sorry, price got rallied. No opportunity here, which is fine. Well, got an opportunity here at what the New York. Here, very small. The price rallied here. We got price rallied here. London close. So we also have here, you can see price came lower and it rallied. So once price has taken external liquidity, we want to put our legs off the gas. Now, I'm going to show us another example, which is the euro, just for the sake of completeness. We can see an example here again. This is an institutional level. It's a weekly time frame, just like we saw. Okay, this is messy. But just from the example I gave in the slides, you can see this is the fair value gap. So let's go to the daily time frame. So every institutional level we're expecting price to rally from. So you can see the trade candle pattern here, trade candle pattern here, trade candle pattern here. Now, usually price doesn't rally like this. What if we're in a market condition, just like we're seeing currently here, although this is a trend? How can you tell what would the bias for the next day likely be? Now, when we see this wrong, we see that market has taken buy-side liquidity and broken structure to the downside. Now, we are at this point. So let me do the replay button here. So this is what we are seeing currently. What do we think will be the next day, the bias of the next day? Looking at this, I'm expecting the bias to be likely bullish, or I might want to wait to see what the next day will be printed. Now, there's something that I failed to explain to you, and I'm going to be explaining it in the next subsequent videos I'm going to be releasing, which is the daily profile. Daily profiles are very important when it comes to understanding bias. Now, this is Friday. Usually Mondays, I usually wait for Mondays to be printed to be able to tell me what the remaining days of the week will be. So I'm going to click push. So I'm going to play it so that we'll see. So you can see Monday, I didn't expand much. So now once Monday is printed like this, I'm expecting that price should do what? Rally into this fair value gap, because price moves from what? External liquidity to what? Internal liquidity. So we can see this happening. Now this is a Tuesday. Now, a very key feature about daily profiles. Tuesday and Thursdays form the high and low of the week, usually, not all the time. But there's something called a classic Tuesday, and Tuesday usually forms the high of the week. So don't worry, I'm just trying to use it here to explain daily bias. But the subsequent videos I'm going to release, I'm going to be going in depth into daily profiles, because using daily profiles help refine knowing what the daily bias will be. Okay, so now going to the charts, I'm expecting Wednesday to be bearish. So I'm going to be selling the next kind of print I'm going to be selling. What happened with how they sell? Why? Because market moves from external to internal, from internal to external. Now, another question you may have is that why do I not expect market to get to this point? This is because there's a fair value gap here. Aside this fair value gap, there's another fair value gap here, which is also an internal liquidity. And because of this here, you can see price took time here. This is consolidation, and price broke this low. If you look at the distance from this point to the net, what I'm trying to explain here is something that will come to you with experience. Like I said in the beginning of this video, there's no quick ABC steps to bias. It's about coupling a lot of things, bringing them together to be able to understand what likely would be the daily bias. And as you continue to practice it, you become better and better. It's all about probabilities. Don't forget that. So now, I don't expect market to start rallying to this fair gap after spending a lot of time here and breaking structure to the downside. Because if price should start rallying to this fair value gap, the probability of price to start falling lower is low. Because at this point, my institutional order flow is bearish. So I don't expect price to start rallying high, because this is a daily time frame. I don't expect price to start rallying high to this fair value gap and then start rallying lower. No. With the manner at which price broke lower, price is fast to seek what? The liquidity below market. So I failed to mention my origin. So here will be the origin. As soon as price breaks structure, I understand that institutional order flow has changed from what? Bullish to bearish. And here is my liquidity, this low, and then probably this low. All right, so let's keep going. Now this has been printed. What do I expect? I expect price to I go into the market expecting price to keep going lower. And that thing, you can see that price has formed what? Three counterparts. So I expect the next day to go lower. And then what happened? We got that. So price expanded lower. So you can see here there's a liquidity. So I'm expecting price to go lower to take out this sell side liquidity. And this is a Thursday, like I explained before. Tuesdays and Thursdays usually forms the high and low of the week. So I expect the next day to actually maybe retrace, which is a Friday. I usually don't like trading Fridays and Mondays. I tend to use them as guides to tell me what the days of the week will be. All right, so Friday might actually be a retracement, so I might not want to trade Friday. Okay, you can see this happening. The next day, I want to go bearish, or which is a Monday, or I might wait to see what will happen. So you can see Monday was bearish, so you can see this happening. I still want to keep going bearish every single time. Okay, you can see here again it's bearish, and this low has not been tapped yet. Price is close to it, so I'm not expecting price to retrace higher anytime soon. I'm expecting what? Bearish price. Good, we've gotten it now. External to internal. All right, so we might go down to a lower time frame to see if there's any market shift. I think the 4 hour or the 1 hour time frame. So I'm doing that here. But you can see our price kept going lower. So every day I'm buying. So once I see this is a three candle pattern, I'll expect price to go into what this fair value gap. So what happens? I outline my fair value gap because price moves from external to what? Internal. So I'm waiting for price to get to this, but price might not get there, and price might get there. So I'm waiting for price to get there, and if it doesn't, good. Now, if this candle is printed already, I'm expecting price to go lower because I'm expecting the next candle to be printed to be bearish. Sorry, I mean to say. Why? Because price has formed relatively equal lows. So what do? We got that neatly. So I'm going to take out this, and this. So let's continue. So we can see we are close to this low. This is what sell-side liquidity. So market has moved from what? Internal liquidity. Now, the internal liquidity might not be clearly seen here, but if you go down to a 4 hour time frame, you might see something. Probably price taking a high. You see our price took out this previous daily high. So it's on internal liquidity. So price right lower. So price is close to this sell-side liquidity. I'll be going bearish. Now I might be wrong. Beautiful. And you can see our price ran bearish because institutional order flow is bearish. You want to be on the side of the institutional order flow. All right. So now this has been tagged, and this is what? Wednesday. So let's see if Thursday wants to go lower. Okay, Thursday did not go lower. Now, when we see this, we want to identify internal liquidity. So what is internal liquidity here? Because external liquidity has been taken, and we are seeing that price wants to go higher. Let me see. We have this fair value gap here because it was left untouched. So I want to see if price wants to go higher. And then what happened? It went higher. So now we are waiting for a three candle pattern to be formed. Okay. All right, this happened as a result of the election. Donald Trump winning. Yay, Donald Trump. So we can see that this low has been taken, and we have what this low here to be taken. So price has not taken this low yet. So we're expecting this low to be taken because this is our drawn liquidity. So we're expecting price to do what? Retrace into this range because we know the market move from internal to external. Now, why did price go higher to this point? I think I could remember calling the markets in the group charts. You can see that this is what a fair value gap. There's a fair value gap here, and price ran into it. So you can see it here. I'll expand the chart so you can see price ran into the internal liquidity after taking what the external liquidity. So this candle took out the external liquidity, and then you can see these 2 weeks here, they run into the internal liquidity. So let's go down to the daily time frame. So at this point, I wouldn't be selling because price is taking external. So price will likely want to go higher. So let's see. So we got that here. And then price finally took out this low. So let's see, where are we now? So price kept going lower because it's hunting. It's trying to hunt this low, and actually got it. So if this happens, this is what Tuesday, I will expect lower prices because we're not really at the end of, we're not really into the week. We're just at the beginning of the week. If this was a Thursday, I would want to sit on my hands or looking for a buy because Friday usually retraces into the range of the week. And that's where we get the model TGIF model. Thank God it's Friday. Okay, we can see Wednesday. Wednesday, actually, I took a trade and I shared it to the group chat. You can see price actually bought on Wednesday because I expected price to rally into this range. What was I looking for? I was looking for this price imbalance, this volume imbalance. I expected price to rally into it because price has taken what? External liquidity here. It took this, it didn't retrace, and then I'm taking this, I'm expecting like a very little retracement, a minor retracement, probably into this fair value gap or this price imbalance. But I actually outlined this price imbalance. I think let me show a trade to you guys. Took a trade. Okay, it won't show because I'm on replay. I think I have to take this replay out. So that's okay. Yeah. So you can see I bought here. Here's what I bought at this point, and then I took my profit as price got into this price balance. So this is where we are currently, and we're looking forward to see price take this low. So now if you ask me, what do I think the bias will be? Now, already established from the start that the institutional order flow is bearish, and we want to see this low taken. This low has been left untaken. So this is our draw on liquidity, meaning that we are still bearish. So don't try to complicate it. Don't try to say, okay, is tomorrow going to be bullish or bearish? You want to be going bearish. Now, the bellwether tools and everything I've taught is just to help you refine to know what specifically the next day will be. Like Monday, which we're expecting to be printed here. Is it going to be bullish or bearish? Usually how I do that, I have already explained that I wait for Mondays to be printed to tell me what will happen next for Tuesday, Wednesday, and Thursdays. So looking at it, usually if you put a gun to my head, I would say the next day that we're printed will be bearish. So let me expand this. Let me log out so that this would log out. Good. So you can see I explained the market move from internal to external range liquidity. So price has taken what? External range liquidity. And we are in, you see how price has filled in this fair leg. This is what? Internal range liquidity. So I'm expecting Monday to be what? Bearish, to run lower. And if Monday doesn't take this low, Tuesday would run lower to take this low and this low. Now, there are many things that could happen, and there are many ways we could deduce the bias of Monday. So you might take a trade tomorrow, which is Monday, and you will lose the trade. Probably Monday expands higher. That's fine. If Monday expands higher, you could see that this is also a trade candle pattern. Monday could expand higher. You want to identify the internal range liquidity. And where's the internal range liquidity? We have this fair value gap here. I have this order block. So you want to be waiting for price to get to either of these points for you to sell. Now, price could as well get to this fair value gap, but I don't expect price to start going higher because we're very close to liquidity. And I'm expecting this liquidity to be taken anytime soon. So even if you take a loss on Monday, you would wait for Tuesday to form the high of the week. And then probably Wednesday would give you that trade candle pattern. If you can't wait for that, you could go to a 4-hour time frame to look for SMT divergence or a market shift. And then you want to outline your market open to wait for price to go above open, market open for a sell. Very simple. Please don't try to complicate it. Once institutional order flow is bearish, you want to be selling. You don't want to be buying when you see market falling like this. No, no, no. Even if you don't understand institutional order flow, you don't understand liquidity that much. Once you see market trending downwards, you want to be selling all the time. Selling, because imagine you sold every day. You can see that they will have few up candles here and more down candles here. So you will make profit. You can't make profit every single time. You have to take a loss. And you don't need to be able to predict every move in the marketplace. There are times you look at the market and you may not know what will happen. You may not know the bias. Once you don't understand what the bias is likely to be, you sit to your hands and wait for more price action. Trying to predict every single move in the marketplace is insane. You cannot do that. And you don't need to know what is going to happen to make money, like Douglas will always say. All you just have to do is to apply risk management and probabilities. All right, so I hope this lecture was very, very, very impactful and has increased your understanding of daily bias. So feel free to ask any question in the comment section. And if there's any topic or anything or any area you want me to talk about, you can as well leave it in the comment section. And as always, I wish you all good luck and good trading.